Have you ever pondered the validity of traditional investment rules? Let's take a moment to think about this. Investing, for a long time, has been considered a game of numbers and strategy, where steadfast rules were followed religiously. These rules were seen as the be-all and end-all of investment wisdom, yet not all that glitters is gold, and not all that is deemed perfect is truly flawless. Are these rules as effective as they're touted to be? We live in a world where the dynamics of investing are rapidly changing. The global economic landscape is not as it was a century. It's a world that doesn't sleep, a world that's interconnected through a complex web of economic systems. Thus, the traditional investment rules are being challenged and questioned. But why question them now? Let's dive into the story of a man who's often referred to as the father of modern investing. Benjamin Graham, an economist, professor, and one of the most influential investors in Graham, was not just a man, he was a phenomenon. Born in 1894 in London, Graham's family moved to New York City when he was a child. Despite the adversity he faced, including the death of his father and subsequent poverty, Graham became the youngest graduate in his class at Columbia University. His intellect was unmatchable, his acumen unparalleled. His journey as an investor is a tale of resilience, of sheer will, and most importantly, of wisdom. Graham chose to challenge the status quo, to look beyond the facade of established norms and to question their effectiveness. He developed his approach to investing, an approach that value at the forefront, hence earning him the title of the father of value investing. This approach, though different, was not without its own rules. Graham set his own principles for investing, rules that were based on the valuation of stocks. But what if we told you that Graham himself at times questioned these rules? Why would he do that? The answer is simple. The world of investing is ever evolving. What worked then doesn't necessarily work now. It's an environment that thrives on innovation and adaptation. Therefore, the very rules that once seemed to be the bedrock of investment wisdom are now being challenged. His journey as an investor is a story that challenges the very rules he himself set. Graham's name is synonymous with value investing. His first book, Securities Analysis, has not only been a bestseller, but also a beacon of wisdom for budding investors worldwide. It is a comprehensive guide that has stood the test of time, maintaining its relevance and importance even in today's dynamic and volatile market conditions. This book is often referred to as the Bible of investing, a testament to its enduring appeal and impact on generations of investors. The beauty of Graham's investing approach lies in its simplicity. He did not advocate for complicated financial models or intricate algorithm-based trading. Instead, his philosophy revolved around the fundamental concept of intrinsic value. He believed that the core of any investment decision should be an assessment of a company's true worth, irrespective of market conditions or temporary financial distress. To implement this, Graham devised a method known as margin of safety. This principle encourages investors to buy stocks when their market prices are significantly lower than their calculated intrinsic values. The difference between the market price and the intrinsic value provides a safety cushion, safeguarding the investment against market fluctuations and unforeseen circumstances. Such an approach brings a degree of caution and prudence into the investment process, making it less susceptible to market risks. Moreover, Graham was a strong proponent of portfolio diversification. For him, putting all your eggs in one basket was a recipe for disaster. He encouraged spreading investments across different sectors and industries to minimize risk and maximize potential returns. This idea is now a cornerstone of modern investment theory, resonating with both individual and institutional investors. Following this simple yet robust investment strategy, Graham achieved an astonishing 20% annualized returns for his investors over a period of 20 years. It was an extraordinary feat given that the market's annualized return over the same period was a mere 12%. His total return translates into a whopping 3,700%. To put this incredible achievement into perspective, if you had invested $1,000 following the market trend, it would have grown to $8,600. However, if you had invested the same amount following Graham's strategy, it would have ballooned to a staggering $37,000. The enormity of Graham's success raises an obvious question: why not follow Graham's rules to achieve similar success? However, here's an intriguing twist. Despite his advocacy for these investment rules, Graham's phenomenal success was largely due to him breaking most of them. The majority of Graham's success can be attributed to his investment in one single growth stock, Geico. This might come as a surprise to many who are well versed in the world of finance and investment. The name Benjamin Graham is synonymous with the concept of value investing. He is known for his formulaic, methodical approach to investing, a strategy that many investors still swear by even today. He is the man who wrote the book literally on intelligent investing, a book that continues to be a must-read for any aspiring investor. However, despite his significant contributions to investment theory, it is a rule-defying move that stands out in Graham's investment portfolio, and that was his to invest in Geico, a growth stock that contradicted his very own preached principles. The decision went against his staunch belief in diversification, a rule he held in high regard. He always emphasized the importance of spreading the risk in an investment portfolio. Yet, despite this, his most successful investment was his stake in Geico. His unexpected decision raised quite a few eyebrows in the finance world at the time, but it demonstrated one key aspect of successful investing, an ability to adapt and evolve in response to changing market dynamics. It showed that while it's essential to have a foundation of principles guiding your investment decisions, there may be situations where breaking those rules could yield significant rewards. This trend of rule breaking is not confined to just Graham. It is also evident in the investment decisions of his most successful student, Warren Buffett. Despite his well-known disinterest in technology stocks, Buffett's most profitable investment to date has been in Apple. This decision, much like his mentor Graham, goes against many of his own investment rules. In fact, Apple now constitutes more than half of Berkshire Hathaway's portfolio, underlining the potential benefits of breaking from convention when circumstances call for it. Despite his known aversion to technology stocks, Buffett's most lucrative investment to date is Apple, which now makes up over half of Berkshire's portfolio. Does this mean that the conventional rules of investing are futile? Not at all. There is an inherent wisdom in observing the traditional guidelines associated with investment. Like a game of chess, the rules provide a framework within which to strategize and make the moves that will, ideally, lead to success. It's important to realize, though, that these rules are not set in stone. They are adaptable, pliable, and should not be viewed as unbreakable. Instead, they should be seen as valuable guidelines, offering a roadmap to navigate the often complex world of investing. They are there to help you understand the rhythm of the market, to learn the language of finance, and to avoid the pitfalls that might otherwise lead to financial ruin. Following these rules diligently will undoubtedly increase your chances of attaining financial stability and achieving reasonable returns on your investments in the long run. But what if you're not satisfied with just reasonable returns? What if you're aiming to truly outshine the market, to become a beacon of success in the investment world? Well, for that you need to be willing to be a little daring. Contrary to popular belief, the boldest and most successful investors are those who are not averse to breaking the rules every once in a while when the situation demands it. However, it must be noted that rule breaking in this context doesn't mean reckless gambling. It refers to tactful deviation from conventional investment norms when a remarkable investment opportunity arises. It's about daring to be different, taking calculated risks and seizing those golden opportunities that only come around once in a blue moon. Such life-changing opportunities are rare, perhaps only 1 or 2 per decade. They lurk in the shadows, hidden amidst the turmoil of economic downturns and the euphoria of bullish markets. They are not easy to spot, let alone seize. But if you have the right knowledge, the mindset, and the courage to act, these rare opportunities can be recognized and capitalized on, leading to astronomical returns that far outpace the average market performance. Remember, in the end, it's not about blindly following the rules or recklessly breaking them. It's about knowing when to adhere and when to deviate for the sake of maximizing returns on your investments. Acting on these opportunities is key to stellar performance. So while you wait for these golden opportunities, continue to abide by the time-tested rules of diversification, buying at reasonable valuations, and owning quality businesses. The world of investment, as you well know, is a world of constant ebbs and flows, peaks and valleys, opportunities and pitfalls. But the true investor, the one who truly understands the game, knows that success is not found in rushing from one possibility to the next, but in waiting, in patience, in meticulous planning and careful observation. The seasoned investor knows that diversification is key. It is not about putting all your eggs in one basket, betting it all on a single stock or bond. It is about spreading your assets, mitigating your risks, and ensuring a balanced portfolio that can withstand the shocks and shifts of the market. Buying at reasonable valuations is another pillar of successful investing. It is not about chasing the latest hot stock or jumping on the bandwagon of the newest trend. It is about understanding the true value of a company, about discerning between the hype and the real potential, about waiting for the right time to buy and the right time to sell. Then there's the matter of owning quality businesses. It's not about numbers and figures, profit margins and balance sheets. It's about the people behind the business, their vision, their passion, their ethics. It's about investing in a company that you believe in, a company that aligns with your values, a company that you can be proud to put your name and your money behind. All of these strategies and principles ensure that you stay in the game long enough. They prevent you from getting swept away by the currents of the market, from losing your footing in the shifting sands of the investment landscape. They prepare you, they armor you, they make you ready to seize that once-in-a-decade opportunity when it comes knocking at your door. So continue to follow these principles, continue to be patient, continue to be diligent. This will ensure you stay in the game long enough to seize that once-in-a-decade opportunity when it comes knocking at your door.